Have you ever wondered how a simple idea, a little hunch about the market, actually becomes a fully automated algorithm trading real money? Well, let me tell you, it's nothing like you see in the movies. No sudden flash of genius. It's really a disciplined, almost scientific process. And today, we're going to break down that exact workflow, step by step. So it really all boils down to this one question. How do you take that fleeting thought, that little observation about how the market seems to behave, and turn it into a cold, hard, logical algorithm that can run 24/7? That's the journey we're going on today, from a simple what if to a fully functioning system. The myth is that these amazing trading ideas just strike like lightning. But the reality, it's way less dramatic, but honestly, much more reliable. It's a methodical process. Think less like painting a masterpiece and more like building a precision Swiss watch. So let's get into exactly how it's done. All right, first up, phase one. I call this the blueprint, because before you even think about writing a single line of code, you have to forge the core idea. This is the foundation, right? It's where you define exactly what you're trying to do and, more importantly, why it should even work at all. This all starts with the raw materials, data. You've got to get it, you've got to analyze it, you have to just immerse yourself in the market. But honestly, the most critical step here, the one people always mess up, is data cleaning. Because if your data is flawed, every single thing you do from this point on, every calculation, every test, is going to be corrupted. It is the absolute definition of garbage in, garbage out. And here is one of the biggest data traps out there, survivorship bias. See, if your historical stock data only includes companies that are, still around today, your results are going to look way too good. It's kind of like trying to judge the health of an entire population by only studying the people who lived past 90. You're completely missing all the failures, which makes the past look incredibly easy to beat. So all of that work, getting the data, cleaning it, analyzing it, it's all designed to get you to one single thing, a clear, specific, and measurable hypothesis. You need to go from a vague feeling like, I think momentum works, to a really concrete statement like, buying stocks that hit a 52-week high and holding them for 30 days tends to outperform the market. Now that is something you can build a system around. Okay, let's move on to phase two, the laboratory. This is where we take our blueprint, our hypothesis, and we actually start building and stress testing the thing. We are going to put this idea through literally thousands of simulations to see if it can take a punch. Now, building the strategy just means defining every single rule with absolute total precision. What are the exact conditions to get into a trade, to get out? How much money do you put on each trade? That's your position size. And what are your big picture risk limits? There can be absolutely zero ambiguity here. So the first big test is what we call backtesting. You're basically taking your rulebook, handing it to a computer, and saying, okay, pretend it's 2010. Now trade according to these exact rules for the next 10 years. This simulation, this is your first and most important reality check. It's where most ideas die, frankly, but it's also where the good ones get their first proof of life. Now, a backtest is going to spit out a whole bunch of numbers. And yeah, total return gets all the headlines, but the pros, they obsess over risk. They're looking at things like the Sharpe ratio, which asks, how much return are we getting for all the volatility we have to suffer through? But the real gut check metric, the true test of your nerve, is maximum drawdown. It tells you the single worst peak-to-valley loss you would have experienced, and that matters because it's a measure of psychological pain. It answers the real question, could you have actually stuck with this thing without panicking and bailing at the worst possible time? But there is a huge, huge trap here. It's so easy to just keep tweaking your rules. What if I change this setting? What if I add another filter? Until your backtest looks like a perfect money-printing machine. This is called curve fitting. And what you've done is you haven't found a market secret, you've just perfectly described the random noise of the past. And a strategy that's built on noise is absolutely guaranteed to fall apart in the future. So how do we avoid that trap? Well, the professional solution is called walk-forward analysis. What you do is you optimize your strategy on one chunk of historical data, say 2010 to 2012. And then you test those perfect settings on the next chunk of data that the system has never seen before, like 2013. You just keep repeating this process, walking forward through time. It's a brilliant way to see if your strategy is genuinely robust or if it was just a historical fluke. So once a strategy has actually survived the lab, it's time for phase three, taking it into the real world. And you have to think of this like the very first test flight of a brand new airplane. You don't just load it up with passengers and hope for the best. You proceed with extreme caution. And that caution is baked right into the deployment plan. First, you're going to paper trade for months, letting the system run in a demo account with zero real money at risk. If it survives that, then you go live, but with what I call scared money. You're risking just a tiny fraction of your normal size. And only after it proves itself in the wild, with real cash on the line, do you start to slowly scale up. Patience isn't just a virtue here, it's literally a survival mechanism. You know, paper trading isn't just about seeing if the strategy makes money. It is the final dress rehearsal. It tests your whole system against real-world friction, things like the delay in getting your orders filled, that's latency, and the tiny difference between the price you expected and the price you actually got, which is called slippage. These tiny little costs can absolutely kill a strategy that looked amazing in a backtest. And when you do finally go live, this number is your most important rule. The pros, they almost never risk more than 1 to 2% of their total capital on any single trade. And why is that? It's because this isn't about getting rich on one big bet. It's about surviving the inevitable losing streaks so you are still in the game to catch the winners. It's not about profit, it's about staying power. And this brings us to the final hurdle. I mean, up until now, this has all been about data, logic, and code. But the second real money is on the line, the biggest challenge becomes, well, you. Can you actually stick to the system when it's losing money? Can you stop yourself from overriding it because you have a gut feeling? This psychological battle is often the hardest one to win. So you've made it through the lab, you've navigated deployment, your system is finally trading live. You're done, right? Huh, not even close. Now, the most important phase of all begins, the never-ending loop. Because the market you built and tested your strategy on, it's already gone. A new one is emerging every single day. This right here is the mindset shift that separates the amateurs from the professionals. You haven't built a static product that you can just put in a box and forget about. No, you've launched a living system. The market conditions that make it profitable today will eventually inevitably fade. Success means treating your system not like a finished object, but like a garden that needs constant tending. And that tending is a constant cycle. You are always monitoring its live performance against what you expected from your backtest. You're analyzing any weird behavior or deviations. And based on that, you're making small, intelligent refinements. Monitor, analyze, refine, and repeat. Forever. And just as important, you need to have predefined kill switches. Rules written in stone for when you just turn the strategy off. What happens if it loses more money than it ever did in the backtest? What if the market itself just fundamentally changes? You have to decide these rules before you're in a big drawdown so that logic, not fear, and not hope is making that final call. And so we end right where we began, with a question. This whole workflow, from the blueprint to the lab to the live monitoring, it's not about finding some single perfect magic formula. It's about building a robust process for creating and managing strategies. Because at the end of the day, the goal isn't to predict the future. It's to build a system that can adapt to it. Because in the markets, the only thing that doesn't change is that everything is always changing.